Well, Adam, on Sunday, we got some new detail on exactly what the Federal Reserve is buying as part of its secondary market corporate credit facility. Keep in mind, this is something that the Federal Reserve has said it would do, but just 2 weeks ago, it finally said that it was in addition to ETF purchases, also going to take on individual corporate bonds. But I want to show you what the aggregate numbers look like so far. If you look at the most recent figures from its weekly balance sheet release, its holdings of corporate bonds and ETFs has ballooned to $8 billion as of just last week. That's really a drop in the bucket when you consider that the Federal Reserve has said it could support up to $750 billion in purchases if it needed. But nonetheless, you can see that the number of corporate bonds and ETFs that it's been holding has really been increasing. But again, as I mentioned, the Fed 2 weeks ago began buying individual corporate bonds, and we just got granular detail about what types of purchases it made yesterday. So here's what the breakdown is. Now, keep in mind, the Federal Reserve is in the process of buying these types of corporate bonds, so it's not here all the way yet. But this is the Fed index, what they call the broad market index that the Fed at some point aspires to have its corporate holdings to look like. So as of June 5th, this is what it would like its index to look like. And you can see the big names here are companies that you should be familiar with, names like Toyota, Volkswagen, Daimler, a lot of car companies on here. AT&T, Apple, Verizon, which by the way is the holding company for Yahoo Finance, also on this list here. These are all substantially large companies that the Federal Reserve could be buying corporate debt in over the next few weeks. Keep in mind, though, these are just the top 10 holdings. The whole list, which the Fed has published on the New York Fed website, includes 794 companies. So yes, these are just the top 10 by holdings, but there are hundreds of other companies that could be part of the Fed's portfolio as well. The Fed has said, however, that it will refresh this list every 4 to 5 weeks, so it's definitely worth keeping an eye on all of this. Now, one important note is, okay, well, is the Federal Reserve going to be buying junk companies as part of this, as you mentioned? The answer is partially yes. So if you break it down by credit rating, double B, which does represent junk bond rating, is only 2.8% of the index that it hopes to have. Over 90%, that means, is going to be in either well-rated AAA to single A rated debt, or what they call investment grade, which would be triple B rated debt. That actually makes up most of the index here. So this is what the composition of the Federal Reserve index as they aspire to have it. But keep in mind, this is something we're going to need to closely watch as we do go through some of the other weeks of this secondary market corporate credit facility. So again,
Sure.
The Federal Reserve dipping into this, but something that needs to be closely watched over the coming weeks.
My grandmother had a word for that kind of, at least what might be junk, which was treif. In Yiddish, it means not so kosher. But let's shift to something else. Is the Fed shifting from ETFs to individual corporate bonds, or do we have a sense of where they're headed?
Yeah, well, when they first announced this program, the first thing that it did was buying ETFs. So junk bond ETFs, investment grade ETFs, a lot of them put together by Vanguard or BlackRock, which, by the way, is one of the advisors to this whole program for the Federal Reserve. But Jerome Powell said in congressional testimony that he wants to shift it towards this broad market index. You can come up with many reasons for why the Fed might want to do that. One of them would be so that the Federal Reserve doesn't have to rely on BlackRock or Vanguard. The Fed can just create its own index to get its own institutional knowledge for which companies might need the backstop here.
All right, investors who want to get in on this or beware of this, what does it mean for Main Street?
Well, the idea here is, yes, a lot of this is financial engineering, and a lot of those people who are looking at this are probably saying, why is the Federal Reserve getting into these corporate bonds in the first place? But the idea here from the Federal Reserve's perspective is to make sure that these companies can still access funding, because as we know, the corporate debt market is such an important part for these companies to find financing. And during the COVID-19 crisis, especially in late March, a lot of companies were not able to get that. So the Federal Reserve here is hoping that a lot of these large companies, not like Apple or GM or any of these other big companies, are necessarily in danger of default, but they want to make sure that these companies can find financing so that they can keep their workers, keep those auto workers, keep those employees on payroll, so that through this COVID-19 crisis, as we continue to go through it, can still get money to put food on their tables.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.